Exercise 21 gives us balance sheet information for Great City Builders as of May 31st, 2014 and June 30th, 2014. They give us total assets and total liabilities. In order to have a complete balance sheet, we need assets, liabilities, and equity because assets equals liabilities plus equity. Because they did not give us the equity, we have to solve for that. And we can solve for the total equity by looking at our total assets, total liabilities, and knowing that total assets equals total liabilities plus equity. So if total assets for May 31st, 2014 is $177,000 and total liabilities for May 31st, 2014 is $122,000, then we know that the total equity is going to be the difference between total assets and total liabilities. So the shareholders' equity or the stockholders' equity at the end of May is going to be $55,000, $177,000 in assets minus $122,000 in liabilities. So we're looking at three separate situations, but regardless of the situation we're looking at, we're going to be looking at the fact that at the end of May, we're going to have shareholders' equity at $55,000 given the same information of May 31st, total assets $177,000, total liabilities $122,000. At the end of the year, end of the month, June 30th, 2014, our total assets is going to be equal to $213,000, total liabilities $144,000. The difference is going to be $69,000. So when we look at total assets $213,000, total liabilities $144,000, total equity $69,000, we know that total assets equals total liabilities plus total equity. So we can fill in the ending balance for the month of $69,000 for each individual situation. So now we need to look at more detailed information. So if we look at the information, it tells us for each of the following situations with regard to common stock and dividends of a corporation, compute the amount of net income or net loss during June 2014. So the first scenario tells us that the company issued $6,000 of common stock and paid no dividends. We know that when we're looking at stockholders' equity, what is going to change the stockholders' equity is going to be common stock or retained earnings. And we know that retained earnings is made up of revenues, expenses, and dividends. We were not given information for revenues and expenses, but we can actually solve for the net of revenues and expenses, which is our net income, by using the information that is given. So if we just plug in the information that we know, then we can solve for the information that we do not know. So the first scenario says the company issued $6,000 of common stock. If we issue $6,000 of common stock, our common stock account is going to increase. If our common stock account increases, that is going to increase our total stockholders' equity. So we have the $6,000 of common stock that is going to increase stockholders' equity. So if we started with $55,000 for scenario A, add the $6,000 of common stock, at that point we have $61,000 of stockholders' equity. We know that at the end of the month we have $69,000. So in order to get from $61,000 to $69,000, the total equity has to go up by $8,000. Equity is going to go up by retained earnings and common stock. We've already discussed the equity going up because of $6,000 of common stock. So now we need to focus on the retained earnings, which is going to be an increase because of net income and a decrease because of dividends. This company did not pay any dividends, so we're not going to have a decrease in the equity because of dividends, which means the total difference of $8,000 is going to be because of net income. So we start with $55,000, issue common stock of $6,000, have net income of $8,000. That gives us $69,000 of equity to be able to pay out in dividends. We did not pay any dividends, so our ending stockholders' equity for scenario A is going to be $69,000. For scenario B, it tells us the company issued no common stock. It paid cash dividends of $10,000. So if no common stock was issued, then the only change in stockholders' equity is going to be due to retained earnings. Retained earnings, again, is going to be the net income minus the dividends for the particular period. So what we know is we started with $55,000 of equity and we ended with $69,000 in equity. If we paid $10,000 in dividends, then we had to have at some point $79,000 of equity. In order to have $79,000 of equity available so that we can pay $10,000 in dividends to leave us with $69,000 at the end of the period. If at some point we had $79,000 of equity, we started with $55,000 of equity. We did not issue any common stock. The difference between the beginning of the period and the amount right before paying out dividends is going to go to net income. So the difference between the $79,000 we had available prior to dividends, the difference between the $79,000 prior to dividends and the beginning equity of $55,000 is going to be $24,000 of net income. The last scenario is the company issued $18,000 of common stock and paid cash dividends of $20,000. So we start with $55,000. We issued $18,000 of stock. We paid out dividends of $20,000. So we need to determine how did we get from $55,000 to $69,000 with those amounts, taking into consideration that equity is also going to be changed by net income. If we end with $69,000, but yet we had paid out dividends of $20,000, at some point we would have had a total of $89,000 of stockholders' equity. That $89,000 would have then been reduced to $69,000 as we paid $20,000 in dividends. So if at some point we had $89,000, but yet we started with $55,000, increased it by $18,000 for the issuance of common stock, the net income is going to be the difference between what we have in equity from the beginning of the period to what we have right before we actually paid dividends. So we're looking at the difference between $89,000 and $55,000. So we know that we have a total difference of $34,000. That $34,000 is divided into $18,000 of common stock and $16,000 of net income.